Let's move on now and discuss bonds. And we've talked in the past about the term premium of longer dated bonds and the risk that globally governments may be unable to fund their spending. And we've heard of interest costs over $1 trillion in the US just on government debt. However, and a lot of this fiscal uncertainty potentially puts upward pressure on bond yields, which is potentially it's unusual in an environment where central banks are cutting rates. However, more recently, you seem to be a bit more concerned about deflation and unemployment in the US. So maybe you could talk about that and what those issues potentially mean for longer dated government bond yields.
Yeah, it's this is a really critical issue, and it's one that, and I think I kind of indicate primarily through my weekly pain report. That's the best way I communicate with people, because it's on a weekly basis.
Yeah.
And I think it's fair to say that for a period of time, I was very focused on the increase in term premiums across much of the developed world. And that, of course, includes the United States, but also focusing on France and the UK. And why was that? It was because, of course, we have this new fiscal reality where governments, particularly in the developed world, have accumulated excessive debt. We had the first kind of round of it as a consequence of the GFC following 2008. And then we had the really big shock of COVID, where governments, particularly in the developed world, spent unimaginable amounts of money and borrowed unimaginable amounts of money. And that inflated all their levels of debt. And then as interest rates rose post-COVID, we then saw this scenario of ever increasing interest costs on their outstanding debt. And at the same time running budget deficits, which meant they had to then finance that budget deficit through the issuance of ever increasing amounts of government bonds. So you've just got a really bad situation. High levels of debt, high levels of borrowing, and ever increasing high levels of interest rates on long-term bonds, compounding this fiscal problem. And I use the United States, France, and the UK as my kind of poster childs of that. So that for some years made me believe that we'll see a steepening in yield curves, which we did get, and an increase in the term premium on longer dated debt. That's not a happy combination. And I've been focusing on that. We also saw, of course, more latterly, some inflation expectations moving higher as a consequence of worries around the short-term ramifications of tariffs. However, so that's the Western developed world. But on the other side of the world, you've got this massive engine room, Eugene, of deflation. And we know that China is experiencing deflation. You've got outright declines in producer prices and also more latterly in consumer prices, although the very latest Chinese CPI data, not PPI, CPI, showed a slight uptick in inflation. But suffice to say, China is now an engine room of deflation. It's kind of reminiscent of Japan following the bursting of their property bubble and financial market bubble. So we saw a bursting of the Chinese property bubble. I would argue, in historical terms, the most epic bubble of them all. And that has just been continuing to deflate. So the real estate market in China continues to be a very deflationary force. But at the same time, the manufactured sector in China is seeing such extraordinary efficiency gains with the implementation of robotics and other forces. So we're seeing a deflation in capital goods prices, and China, to get out of their economic trouble, need to increase exports of capital goods. So they flooded the world with cheaper capital goods. So we've got this kind of juxtaposition where we've got some inflationary pressures in the West, and particularly in the services sector. However, in the East, and the largest manufacturer of capital goods in the world is namely China, of course, you've got this deflationary pressure from the East. So when you look at it from a West-East kind of tsunami effect, those forces are now colliding. However, in the background, we've had the advent and now seeing the accelerated implementation of artificial intelligence. So what I've been trying to do, Eugene, in the last, quite some time now, is to thread this all together. Where do we end up?
Yeah.
Because as AI becomes more popular and is implemented across companies, and I'm not sure if we're going to talk specifically about AI later, I'm a big believer in AI, and I believe virtually every company in the world is going to utilize and use AI in some way. And that ultimately, to me, will put, unfortunately, very unfortunately, upward pressure on unemployment. More people will lose jobs as AI is introduced. And so basically, you've got this very big picture, medium to long-term deflationary environment But in the short term, we've got higher upward pressure because of tariffs, but we think that will dissipate as we get into 2026, accompanied by ever increasing financing demands from government. So I'm now kind of having to tussle this, and my jigsaw puzzle is getting a bit messy. So I decided to back off on my hard kind of core conviction view that long-term yields in the West will continue rising. I think we've kind of reached a point almost of equilibrium. And the other thing, Eugene, is the central banks in the West, have been cutting rates, short-term rates, because they're now seeing these forces of higher unemployment, and they're now seeing the disinflationary impact of AI. So how do I thread that into my jigsaw puzzle? So as I've said in our recent investment committees, I used to be kind of banging the table about steepening yield curves and elevated term premiums and longer dated Western government debt. I'm now backing off a little bit because I'm having to acknowledge some of those deflationary forces. I don't know if that makes sense.
Makes sense. I mean, in a sense that you've got inflationary pressures and from the fiscal situation. I mean, the Western world's been gorging on debt now for decades, and that creates risk for bondholders, right? So that's pushed up, and we saw a lot of that when the US central bank started cutting rates, but long-term bond yields went up, right? Which doesn't make sense until you explain or understand the other forces at work there. But then technology tends to be deflationary, right? Whether it's AI or other technology. So whenever there's technological advancement, the cost of doing most things comes down. It'll put upward pressure on unemployment, I think. But then it also creates opportunities to increase productivity. So, but I can see what you're saying, that one will offset the other. And it's in a way, it's good to have opposing forces in that, because perhaps that creates a bit more stability with bond yields. I think the other point here that we haven't discussed is quantitative tightening, which is about to come to an end.
Yes.
Which leaves the door open. So quantitative tightening is basically central banks selling their bond holdings back to the market, which puts upward pressure on bond yields. Upward pressure on bond yields, downward pressure on price. If they were to stop doing that, that would be good for the bond market in a sense. Yields could potentially come down, but it also leaves the door open for them to go back to doing quantitative easing in a situation where they want to control yield. Is that right, Ish?
I think you're absolutely right. And I think you're absolutely right. And that's another factor that we've had to thread into this kind of conversation. It's another piece in the jigsaw puzzle. You're absolutely right to point it out. The cessation of QT and then basically opening the door ever so slightly to the prospect of them returning to QE. By the way, at some point in time, I don't know when it is, and it's probably not something to throw into this conversation today, but we will see a resumption of QE at some point in time. Once these central banks and various people get the taste of something, they'll always come back to it, and we might even see yield curve control. But that's a conversation for
down the track, for sure. So anyway, I suppose the long and the short of it is we're less concerned about long-term bond yields, but there's still a lot of value in the high quality credit market as well. So from an asset allocation point of view, but we might talk about that a little bit further on.